You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back once again. It is Wednesday, Education Wednesday here on the network. That means we are holding court once again with the premier options educational program. Yes, it is time once again for Options Bootcamp. My name, of course, Mark Longo from the THE OptionsInsider.com. Check it out if you haven't been there in a bit. A lot of great content, earnings, vol, all the cool stuff that we give you over there. Great links to all of our shows. You could really spend a lot of time over there if you are so inclined. And, of course, if you want to go above and beyond, you want to get access to all the great, cool stuff going off over there on the pro side, including a little bit later today. We got a pro Q&A coming up with the last emperor himself, Mr. Constantine Vrandopoulos from Fidelity. You want to get access to that and everything else we've done over there, 200-plus episodes at your fingertips the second you hit that button, theoptionsinsider.com/pro. The place to go to learn more. Welcome to all of our new members. I am remiss in welcoming you all the time. So here I am, welcoming you officially, all the new folks who joined up recently. Happy to see you all in there on the Q&As, on the live chats, and everything else we got cooking over there. Of course, you get your name in the hat for the pro trading crates as well. So a lot of cool stuff popping off. theoptionsinsider.com/pro. Of course, if you like what you hear, this, anything else we do here on the network, all we ask is that you throw a review our way. Just like this week, our 5-star review comes from Mongol, but with a U. Mongol with a U. Interesting. Saying, I'm not sure what he's saying, actually. He says, bring into options pain every week on OBC, exclamation point. I guess that's a good thing. Bring in the pain. He gave us 5 stars. So I guess he liked it. But yeah, I guess we're bringing the options pain. Joining me to help bring that pain this week. He's always bringing pain to me. You don't see it. Off the show listeners, the stuff I have to put up with this guy. But you know what? We do it for you. He is Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show. And what do you think about us bringing the options pain every week? I guess that's a good thing.
No pain, no gain. You know, that's how it works.
There you go. We are drill instructors ostensibly on this show, right? So I guess there should be a little bit of pain out there. All right. So I guess Mongol liking. Yeah, his rating was good, so he had to like the show, I suppose. I love it. I love it. Thanks to everyone, I should say, it takes the time to rate and review, throw some stars our way, as it's time for us to throw some basic training your way.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in. Prepare to learn. Yes, sir.
All right, everybody. Welcome to a little bit of the old basic training portion of the show where we break down some basic options concept or technique or strategy and explain how you can utilize it in your own portfolios. And Mr. P, the last time you and I were together on the old program last week, we got into a little bit of a conversation about risk reversals, the bullish, the bearish, the collar variety. A lot to unpack there. And so it became apparent it might be a good time to review and revisit that topic area for our audience. So, Mr. P, when I throw those terms out to you, when I just say to you the term risk reversal, what does that bring to mind? What do you think of when you hear that term, sir?
Well, I mean, a couple of things. I mean, for me, I start thinking along the lines of collars, which is sort of related. A risk reversal is part of that. And then some creative strategies. I got kind of a lot to say about that. I mean, one other thing, too, is that like different areas of our business calls risk reversals different things. I think when I was on the commodity floor, what was it? I think they would just call it like part of a conversion reversal, whereas we would call, as equity options people, we would call it two different strikes specifically. So, it has a lot of names. And so when we're talking about this kind of stuff, that's why I asked you before the show. So you're talking about the version where it's this. So just kind of clarifying. And I think throughout the show, I'll want to make sure we do that for all the folks listening too, so they know exactly what we mean every time.
Yeah, there is a lot of confusing terminology floating about out there in the world of options, even for this term, risk reversal. I first encountered it back on the floor when I was a market maker. And you're really, at the end of the day, what you're doing, listeners, is you're trading skew. So it was kind of introduced to me as a way to effectively reverse the skew risk of your position. If, let's say, you're long a bunch of puts and you're short a bunch of calls, maybe you want to flip that around because you traded a lot of skew when you're managing your position at the end of the day as an options market maker, listener. So you come in, maybe sell some puts and buy some calls, do the old bullish risk reversal. And therefore, you're reversing your risk from that perspective. But there is a lot of confusion with this, as Dan mentioned, when you're doing those single strike synthetics. That's what we've talked about on this show in the past. You can look at the archives as well. Those are more conversions and reversals, different topic entirely. You're kind of trading synthetics, and you're doing that all effectively. It's 1 or 100 delta. You're effectively trading synthetic versions of the underlying. We're not quite doing that here. We're going to spread it out a little bit, going to spread the strikes a little bit away from the at the money. You're going to get a nice meaty bite at the apple, but not quite a 1 or 100 delta here. So let's get into it. What are we talking about here? Let's go with the old bullish risk reversal first. This is a strategy I like. It doesn't get a lot of love, which I thought was another reason why it was good to revisit it here on the show today. So what are we talking about? Let's go to our old friend XYZ, a name we've all made and lost epic fortunes upon. XYZ trading $100 right now in our example. You're looking at it and you're thinking, I like this. I think this bad boy is going to pop. But maybe you're kind of light on funds right now. Maybe you just don't want to commit to the full outright fun, the joy, the effervescence of buying that stock outright and then living and dying with every tick of the underlying. There's a lot of different reasons why maybe you can't or won't buy the stock, but you have a bullish outlook on it, and maybe you want to participate on it over the next month. You think it's going to move a bit. So in our example, you turn around, you decide you're going to trade a little bit of the old bullish risk reversal. So you start with the first step, the meaty leg. You're going to turn around and you're going to sell, in our example, the 1 month, so just the front month, a 95 strike put. Now you've sold a put that is now $5 out of the money. We talked about that a million times on this network and on this show. Your cash secured puts, your straight up just short puts. Look into the archives of this or many shows if you want more information on those. In our example, you sell that for $1. So right away, you've sold a 95 strike put for $1. You have an effective break even to the downside of $94. That means that the stock drops below 95, you're going to be on the hook for buying it at $94, no matter what else happens. So you already know the pros and cons of the short put, the primary pro being you collect $1. Now, to the downside, you might say, okay, well, that's interesting. You got a short put. What's the other part of this? And now you're saying, well, I sold this put. That's obviously a bullish trade, hence the name bullish risk reversal, but you're not participating in all that upside if this thing does pop. And in your outlook, you're thinking this thing might pop over the next month. So you want a little bit of skin to the upside as well. And that's where the other part of the bullish risk reversal comes in. In our example, you're going to buy the 105 strike call. So you sold a $5 out of the money put. You're going to buy now a $5 out of the money call. Remember, in most equity and index options, the puts are going to trade at a higher level of implied volatility than the calls. So in our example, that 105 strike call, even though it is equidistant from an out-of-the-money perspective, is going to be trading at roughly half the value. In our example, 50 cents for that call. So you sold a put for $1. you bought this 105 strike call now for 50 cents. What have you done? Well, first off, you've obviously reduced your credit to 50 cents from $1. So if the stock drops now, instead of getting that cushion all the way down to $94, your cushion has moved up a bit. Now your break even to the downside, where you're going to be buying the stock, is $94.50. But to the upside, now what happens is you have all that upside room to run. So if this stock starts running, you get to participate on anything that happens above the 105 strike. It's called a bullish risk reversal. You're selling an out of the money put. So that is in and of itself a long delta, a bullish trade, because you're selling a negative delta option. Remember, you flip the sign, listeners. That's a positive delta trade. And then also on top of that, you're buying an out of the money call, also a positive delta trade. Remember, you're going to add these two together, selling one, buying the other. So now your net delta is going to be somewhere, in our example, probably north of 50. Let's say in our example, the 95 strike put is about a 30 delta, and let's say the 105 strike call is about a 30 delta. So you're putting on effectively a long 60 delta position. So as you can see right away, it's not quite what we were talking about before, the synthetic where you're long 1-to-1 with the stock, but you're getting a nice meaty bite of the apple. It's a pretty decently bullish trade, all things considered, and for a relatively modest outlay, or in this case, actually a credit. So that's what makes these types of trades and this strategy attractive for a lot of people. It's a relatively low cost, or in this case, a credit way to get an upside swing at the bat. And that's what you want in this name here. So let's walk through a couple of scenarios. The stock expires above 105. What happens there? You get all the juice, all the action above the 105 strike. Let's say, for example, it closes at 107 at expiration. So you sold that put, remember, for $1. You bought that 105 call for 50 cents. So net credit, 50 cents there. And then, of course, that call went out at $2. So call worth $2 at the end of the day, plus you collected that 50-cent credit. So you're not making $2.50 on this trade, which, again, not a bad do, as they used to say down there on the floor. And your outlay was pretty nominal. All your broker is going to do is tie up the capital for that short put, which, again, if you're confused about how that works, check out some of our archives. We've gone deep into how brokers calculate the capital for short puts in the past. It's a little bit of voodoo, but there are a few formulas that they rely on. So check that out if you are so inclined. Now, scenario 2, the stock closes somewhere between the 95 strike and the 105 strike, in which case nothing really happens to your position. You just end up keeping that 50-cent credit. The call you bought for 50 cents goes out worthless. The put you sold for $1 goes out worthless. You end up net keeping that 50 cents. And then scenario 3, the stock drops and closes at expiration below the 95 strike. You're going to buy that stock, and your effective break-even price, or your effective stock buying price now, is $94.50. So you're talking the 95 strike minus the 50-cent credit that you collected. So there you go. That's a bullish risk reversal in a nutshell. All options, no stock leg involved there, but an intriguing low cost, or sometimes if you do it right, even a credit way to get a bite at the apple for a little bit of a near-term pop in a particular underlying. Mr. P, sir, what are your thoughts on the example we laid down? What are your thoughts on the bullish risk reversal in general, and maybe your use cases for it, sir?
You know, I think I've said this on a past show. I don't trade this bullish risk reversal very often. I mean, there are some times when I do, but not very often. I have noted when I watch order flow that sometimes you see some of these big ones go through. So, I mean, it is a viable strategy. There are some pros trading this for sure. But, you know, my thought on it is I would like to tell people not to get super hung up on the credit. Like, the credit is like on a trade like this, the credit is really, to me, the credit is really just sort of like an accounting thing that isn't really relevant. The real cost of this to you is the real cost of it is to you the margin they have to put up, and that's cash that you don't necessarily have to pay, but it's cash that gets earmarked that you can't otherwise use in your account. It's margin that gets tied up, and so I mean, I look at these trades as a very leveraged debit transaction. But, there's a lot of strength to them. I mean, I think when I use these, I typically use them to buy a call that I have some pretty good confidence in on the trade, and then sell a put to finance usually part of that call. I mean, if you're going equidistant from the at the money to the call strike to the put strike, you can do a credit, but sometimes I'll go a little bit further out with the put strike and take advantage of it that way. And I'm okay even if it's a tiny debit. It's to me, it's just getting better leverage on the call, while massively better leverage on the call, while taking on a little bit of downside risk to finance that massive leverage.
Yeah, there's a lot of ways you can play with this bullish risk reversal. I just kind of gave you the obvious straight up, set it up at the onset. Some people like to come in and they sell the put first, and they like to get a feel for the underlying first. I kind of refer to them as inertial risk reversals. They'll see if the stock is going to pop a little bit, and then they'll follow up a little bit later, maybe a session or two later, maybe longer, with actually buying the call. They won't do it at the outset. They don't want to commit to the call right away. Some of them maybe are just trying to cling to that precious bit of premium they're harvesting for the puts. So that's one way you could do it. Another way, as Dan mentioned, the capital is going to be intensive for that put, so you might be inclined instead to sell a put spread instead of just selling the put outright. That's, of course, going to reduce your outlay, but also going to eliminate a lot of that margin cost as a result. So, again, pros and cons to each, many different ways to do a bullish risk reversal. But if you're looking for a nice kind of a low-cost way to take a bullish swing for the fences out there, maybe even a nice little bunch or two on a particular underlying, you don't want to shell out all the money for the stock straight up or just a straight at the money call, this is one way you could go about it. And then let's flip the script. Now let's look at another underlying, XYZ, everyone's favorite, that you're maybe a little bit bearish on this time. You're looking at XYZ and you're like, I don't know about this one. It's trading $100 yet again. You come in, you decide, you know what? I think this thing is going to fall out of bed over the next month for a variety of reasons. Maybe you don't have the capital. Maybe you don't want to just take the infinite risk to short the stock. For whatever reason, you don't want to go that route. So you decide to come in instead, and now you're going to buy, again, same scenario, we're just flipping the script. You're going to buy this time instead of sell the 1 month 95 strike put, again, paying that $1 level that we talked about earlier. So same deal. You buy that put now, the stock drops, you participate on all the downside below that 95 strike with your break even beginning at 94. So everything you know about buying a put, very straightforward there. The con is pretty obvious. That's a very expensive trade. So you might say to yourself, maybe I want to defray some of the outlay for this. So you turn around and instead of just buying that put and saying, you know what, let's just let the dice fly, I'm going to ride for that whole $1, you're going to sell in this case instead of buying. You're going to sell the 105 strike call. Again, in our example, 50 cents. So it's pretty much the exact same thing. We're just flipping everything around now. You're selling that 105 strike call. You're collecting 50 cents. You have now reduced your net outlay on this trade to a 50-cent debit for that put rather than paying $1. So the pro is obvious. You cut your outlay in half. The downside, though, maybe less obvious, but pretty stark in this case. You sell a naked call to the upside in anything, listeners, and we've counseled you against doing this many times on this show in the past. You sell a naked call on anything, your broker is going to margin you to hell for obvious reasons. I mean, look what happened back in 2021. They saw the amazing unlimited risk that can happen to the upside in a variety of names. Just look at GameStop and AMC and everything else that exploded to the upside that year or has done so over the last few months. You can see there is unlimited risk to the upside. Your broker is going to margin you that way. So that call you collected 50 cents for, it's going to tie up probably the rest of your account from a margin perspective, or pretty darn close to it. So it's up to you whether you think that 50 cent you're collecting, 50 cents worth of premium, is worth it at the end of the day. Now, to get around that, I think the practical way most people are actually going to do this, rather than just naked selling the 105 call, is buy another out-of-the-money call against it, turn that into a spread. That's going to take away all that margin risk, and all you're really worried about is the value of that spread. So maybe in our example, you can come back and buy the 110 call against the 105 call that you sold In this case, the 110 call is trading for 25 cents. So now what have you done? You've effectively sold the 105, 110 call spread for a quarter. Remember, a spread can only be worth the max of the value in between those two strikes. So in this case, that's max value could be $5. So you sold a potential $5 spread for 25 cents. Not exactly the best trade, but that's one way to reduce that margin outlay there. So that's your basic bearish risk reversal. In our example, you paid a $1 for the 95 strike put. You sold the 105, 110 call spread. And for that spread, you collected only 25 cents. So your net outlay is now 75 cents. So you have reduced your outlay, but not a ton. So in this example, if the stock closes anywhere between 105 and 110, you're going to lose pretty much the whole value of that spread minus the 25 cents you sold it for. And then, of course, if the stock closes between $95 and 105, remember, you paid 75 cents at the end of the day as a debit for this spread, you're going to lose all of that because your call spread that you sold goes out worthless, but also that put that you bought goes out worthless, and that's the most expensive, the meatiest leg of this trade. And if the stock drops and it expires below the 95 strike, you're going to buy that stock. Remember, you paid 75 cents for this trade. So as you can tell, I'm not overly enthusiastic about this. I threw it in there because we want to clearly delineate between doing this with stock and without stock. You can see when you do it just with the options without stock, it doesn't really make a heck of a lot of sense. So let's instead revisit this the way most people are going to see it, the way most people are going to do it, which is as a collar. And so now what the collar means is that you're going to actually have a stock leg with this trade. So in this example now, take everything we just talked about, but instead of just looking at the XYZ strike and saying, maybe I'm concerned about a little bit of near-term downside, or I'm looking for a little bit of near-term downside, you're now long the stock. You're long XYZ, 100 shares of it trading at $100. And so you could do all that same math before. You buy the put for $1. You could sell that same call for 50 cents, but now you don't need to buy the farther out of the money call against it. And you don't have to worry about the margin for this because you own the stock now. So it takes a lot of the concerns of this position away. So now let's say you own XYZ stock. You bought the 95 strike put for $1. You sold the 105 strike call for 50 cents. Your net outlay now 50 cents for this position. Let's walk through the scenarios again. The stock expires north of 105. Remember, your stock gets called away. You own the stock now, so you don't have to worry about the margin side of it. You don't have to worry about the infinite short risk of shorting stock. You are letting your stock go, but remember, you paid 50 cents for this position, so you're letting it go not at 105, but your effective sale price is going to be 104.50. To the downside, same deal, you're stopped out at the 95 strike, so if the stock falls out of bed, you're protected, but you paid 50 cents for this position, so your price is going to be 50 cents off of that 95 strike. So as you can see, this scenario makes more sense with a stock leg than without it, but you can encounter it, and you may see it talked about both ways. Mr. P, what are your thoughts on the bearish risk reversal? So pretty much just the options, ma'am, and then doing it the collar way with stock, the more common way.
Yeah, the straight bearish risk reversal with no stock is something I don't really have too much interest in. I mean, I could count on one hand how many times I've just sold a naked call in the last 5 years. So it's just not a game that I like to play that much. I mean, what are you really doing? I mean, I would say what you're doing is you're financing a long put by selling a call and adding a lot more margin to it. So are you really, are you financing? I guess you are from a credit and debit standpoint, but so what? You're probably tying up a lot more capital. If you look at it that way, like risk or, reward potential to margin, it's probably a worsely leveraged trade. So, yeah, I don't like that. But as far as collars go, I love them. And I teach deviations of the straight collar as well, but that's probably a little bit more than we have time to get into for today's show. But, like a note, too, is that when it comes to collars, like you're not just like running around collaring everything you see. You know, it's a very niche strategy. It's another one that I put on. I don't know how often, a couple of times a year, maybe. No, probably a handful of times a year when the situation presents itself. And when it does, it is the exact perfect strategy and it works great. And until it does, I just keep it as a little tool in my toolbox that I'm waiting to use.
Yes, these are just a couple of strategies you could use. Collar, hopefully you're going to do that, the collar versus the bearish risk reversal way. The bullish risk reversal, an intriguing way to get some lower cost bites at the apple out there. With all of these, I would caution you to not fixate on the debits and credits as much as the strikes. When we talk about collars, a lot of people get fixated on things like zero cost collars. They want the put premium to line up perfectly with the call premium. And as we all know, for reasons we laid out on the show today, the skew in equities makes that very challenging. You have to move your calls around very tight to the at the money. You have to move your puts farther out. Set them up with the strikes you want, and then go from there from a premium perspective. Don't just get obsessed with trying to make things line up. We said this before when we had our episode about collars, just pure collar episode here on the show. You're very rarely going to get those things to line up in an ideal scenario. So don't get fixated on zero cost, because if you make things gear around premium all the time, it's not going to be an optimal position for you at the end of the day. It's going to line up from a premium outlay perspective, but it's not going to line up from your strikes and duration and everything else that you really want, the things that are really important. So I talked about the premium outlays and the debits and the credits here so you have an understanding of how they work, but don't fixate on that stuff. You should fixate more on the strikes. Where do you want to stop yourself out at? Where are you okay letting the stock go on a collar? Vice versa, where are you okay buying the stock on the bullish risk reversal? Where are you okay maybe participating in on the upside? And think of things that way. And then hopefully it works out so you get some sort of decent credit or reduced outlay for it. But don't make that the goal of your position at the end of the day. As we keep on rolling, get a little bit of your mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, let's go here really quickly. A lot of folks enjoying the chat about the risk reversal. Looking forward to Constantine coming up a little bit later for the Pro Q&A. Yeah, that'll be fun. In a little bit out there as well. People talking about AMC. Got Age talking about AMC. He's never seen something so crazy with all the reverse splits. Yeah, AMC has been an impressive one, to say the least. Off another 60 cents today, or 22%. You know, all this ape conversion, dilution stuff. Really just crushing this thing. As you mentioned, the reverse splits prior to that. A lot of value eration, value devastation going on out there right now in AMC. Hopefully, if you had this one on, this would have been a good scenario to have a collar on in your back pocket. And because people were so giddy to the upside, you probably could have gotten that call off or actually a decent vol level and probably paid for a fair amount of your put, if not all of it. So that would have been maybe a favorable scenario for a collar. Right now, obviously not so much. Those puts are exploding. Those calls, not so much. But it's one of those scenarios. You want to have it on before the horse leaves the barn. But this would have been a good example for a little bit of the old collar action. Mr. P, tell you what, I'll hit you with our question of the week. Our question of the week right now, Mr. P. Love to get your thoughts on it. When we asked this question back in the beginning of the year, and then we asked it again back in May, cash was king. We want to check in with this again to see if things have changed. Very simple question. These troubled times, where are you allocating the majority of your portfolio? Cash, fixed income, equities, or commodities? Mr. Dan, what is your vote, and what do you think our audience is voting for?
I mean, my vote is equities. I've just been sort of riding this a bit, and I think that that's probably what our group is going to say.
Let's see what we've got out there, listeners. And right now, oh my, exactly tied 35.9% each for cash and for equities, Mr. Dan. Wow. That's eerily specific. Not even a tenth of a point difference between the two. Then 17.9% for fixed income, 10.3% for commodities. This is, of course, Education Wednesday. You have till the end of the week. At Options, the place to go to make your voice heard. Before we go, Mr. Dan, we got to get this one on from our episode last week. Remember last week we were talking about stock certificates, Mr. P, and if those were still a thing. You recall that, sir?
Yeah.
Well, we got this comment here from JT, and JT just said, just so you guys know, collecting old stock certificates is definitely, puts it in caps, definitely a thing. It's called Scripophily, and you can learn more about it at scripophily.net. So I did check out his link, Dan, and yeah, there is this whole subculture. I mean, everything is a collectible these days. That part of the economy has exploded, and that apparently includes old stock certificates. Booming market for these things. You should check this. Have you checked out this link, Dan? Have you seen this?
No. What is it again?
Scripophily. It's in the notes. SCRIPOPHILY.net. So there you go. Our listeners taught me a term. I like to think I have a pretty decent vocabulary, but Scripophily, not a term I have encountered before. So I learned a new one this week, listeners. You can go check that out for yourselves. If you too want to get into the hot area of collectible stock certificates. I love our listeners. You guys make us aware of everything and sundry under the sun. Now, in hindsight, it makes perfect sense that there would be a booming collectible market for old stock certificates. It's just it brings a smile to my face, nonetheless. So, Mr. Dan, I know you're knee-deep in that URL right now. You're having a ball at scripophily.net. If you can pull yourself away for 2 seconds to plug your stuff. If folks want to perhaps check out your URL and debate the merits of Scripophily with you, where should they go? What should they do?
You can always find us at marketstaker.com, 2 T's in a row. And, send in your Scripo files or welcome to all Scripo files. That's got to be what they call people who follow this, right?
Yeah, I guess every subculture wants to sound cooler than it is, right? You can't be a coin collector. You're a numismatist, right? So you can't be a stock certificate collector. You're a Scripophile. But we love it. Maybe Dan's going to open up a little forum for all you Scripophiles out there. You can sling your certificates back and forth. How about the file? I got some old IBM or Raytheon sitting in a drawer somewhere from my grandfather. There must be some value to that. I'll see if I can go dig those up. Mr. Dan. Unfortunately, that music means we've come to the end of OBC for this week, but for all you pro folks hanging out in the chat, debating AMC and risk reversals and maybe a little bit of Scripophily yourselves, hang out. We'll be back in a little bit now with the last emperor himself, Mr. Constantine Vrandopoulos from Fidelity, to tackle all of your questions about this market and much more. Back again tomorrow, of course, with our double dose of the option block and This Week in Futures Options. Friday, vol views for all your pro folks. Back again with Options Oddities. The Rock Lobster will be back. He'll be joining me for that. And then back again on Monday, kicking things off with the option block all the way through to next Education Wednesday and another great Options Boot Camp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.